Okay, so good morning everybody. Let us learn the indirect cash flows method for operating activities. So this is a part of your cash flow preparation. So we'll be looking at the indirect method for preparing the cash flows as per IS 7. This is a format for the indirect method for preparation of your cash flows. This is a standard format and we can amend it according to the question and if add anything else or remove everything else which is not required as per the question. So we start with your profit before tax, picking it up from the statement of profit or loss account. Add back the non-cash expenditures like the depreciation, interest expense, loss or profit on the sale of non-current shares. We add them back because they are non-cash expenditures, and since we are trying to prepare a cash flow, we will be only including the cash information here. One thing I would like to say here is that the difference between the indirect and the direct method of cash flows will only come broadly with respect to preparation of cash flow from operating activities. The other two sections of a cash flow, which are your cash flows from investing activities and cash flow from financing activities, will not make so much of a difference. So the basic difference will come only under the indirect method or the direct method with respect to preparation of cash flows under the operating activities. So we do add back all the non-cash expenditure to your profit before tax so that we come down to a profit which is already not deducted for your non-cash expenditure. We arrive at a profit. And then we try to do some adjustments with respect to your current assets and current liabilities. If at all there is an increase in the current assets, increase in the current assets, for example, in the current year, if the inventory is 200, in the previous year, if it was 180, that means the inventory has increased by $20. Generally, people think that if the current assets are increasing, it means more cash for us. However, that is not correct. If your inventory has increased from 180 to $200, that is an increase of $20. It means that $20 of more cash is blocked into inventory. From cash point of view, an increase in a current asset would decrease your cash balances. This is the reason we subtract any increase in the current assets, and vice versa. On the reverse logic, we add all the decrease in the current assets. For example, in the previous year, if inventory was 250, in the current year, if the inventory is $200, that means you have been able to realize $50 of cash. This is the reason we add all the decrease in the current assets. On the contrary, for the current liabilities, the treatment is just the opposite. We add all the increase in the current liabilities. For example, if the creditors have become from $200 to $250, we will add any increase in the current liabilities. It means probably you have purchased something from them. That is the reason the current liabilities are increasing, and you have not paid them yet. So it will be an increase in the current liabilities. Your cash is not going out. And when you pay off to the current liabilities, your cash goes out. This is the reason any decrease in the current liabilities is subtracted. This indirect method focuses not on the T accounts, but we focus on trying to get your net cash from operating activities using the movement in the current assets and current liabilities from your previous year to your current year. This will give your cash generated from operations. Anything else which you have paid in cash, like interest, dividends paid, or income taxes, this you can reduce and find out your net cash flows from operating activities. Let us look at a sample question to help you understand this better. So this is a company and this is their profit and loss account, and the balance sheet has been given to us. We are trying to understand how to prepare the cash flow statement using the indirect method. So this is the profit and loss account. Sales has been given and few expenses, profit before tax, income taxes and profit after tax figures have been given to us. Even the balance sheet has been given to us, inclusive of your assets, liabilities and equity. We will look at a step-by-step approach on how to make cash flows from operating activities using an indirect method. The first step is to analyze the balance sheet. But when we are trying to analyze the balance sheet, we need to keep a few things in mind. The first thing is that we will be only analyzing the movement in your current assets and current liabilities. The other things like the long-term assets or long-term liabilities or even your equity shall be ignored. As I told you that in your net cash flow from operating activities, the basic thing which plays a role is your movement in your current assets and current liabilities. So that is what we would be analyzing, ignoring the other factors. And while we are trying to analyze the balance sheet for your current assets, we shall not be analyzing the cash. The reason being we are preparing the cash flows. So we are trying to accommodate for the movement in the year which has happened in the cash flows. This is the reason. Apart from cash, all the other current assets and current liabilities shall be looked into. For example, in this particular problem, in 2014, your trade receivable was $32,500. In the current year, it has become 25,000. That means trade receivables have decreased by $7,500. Similarly, insurance has come down by $2,000 and your inventory, it was 34 in the previous year. In the current year, it is 37,000. It has increased by $3,000. Fixed assets, we are supposed to ignore. Long-term assets, we come down to your current liabilities, trade payables and accruals. These are the only two current liabilities in this particular problem. Trade payables have increased from 16 to 18, a 2,000 increase, and accruals, which could be your liabilities to pay or other things, has decreased from 7 to 4, a negative of 3,000. You can quickly do an analyzation of the balance sheet in a rough estimate and try to do these calculations with respect to current assets and current liabilities only, ignoring the cash movement. Then we come down to your format. Try to start putting in things in the format. We saw that the profit before tax from the statement of profit and loss account was $1,000. We add back the depreciation from your profit and loss account for 15,000. Inventory has increased. It is an increase in the current asset to be subtracted. Likewise, trade receivables and prepaid insurance have faced a decrease. So we looked into the format that increase in the current assets are supposed to be subtracted and decrease in the current assets are supposed to be added back. Likewise, current liabilities increases are supposed to be added. Current liabilities decrease are supposed to be subtracted. If we do all the calculations, the net cash generated from operations before taxes would be 21,500. After taxes, it will be 21,200. So I hope this session was useful in terms of calculating cash flows using the indirect method. And a bit about FxMantra. So we are finance and accounting education specialists. We provide online classes, practice questions, doubt clarifying sessions. We have customized packets starting at $100. If you want more updates on the subject and free doubt clarifying sessions, please join our Facebook group. The link is there on the screen for your information. Thank you, and I hope the session was useful.